Introduction. Welcome to your first step of your cryptocurrency journey. Perhaps you have a little extra income and are looking for somewhere to make it work for you. Maybe you have zero trading experience and find that the stock market does not hold your interest. Do you find yourself drawn towards investing cryptocurrency as a potential wise choice for the future? There has been a lot of excitement surrounding Bitcoin and other cryptos in the last year. The prices have risen and crashed with celebrities commenting on how they are investing and giving their 2 cents. You've probably seen plenty of people who have completely turned their lives around through investment and want to get in on the action. And honestly, why wouldn't you? You may have a lot of questions about cryptocurrency. You may also have a superficial understanding of what the currency is, let alone trading in a traditional sense, but have come to the astute realization that in order to adequately achieve your financial goals or dreams, that you need to invest. Researching is a great place to determine if it is in the cards of your future. This book manages to squeeze all the information into a few pages that you will need to get started and make confident decisions. Forearmed is forewarned, as they say, and this book will be a fantastic tool in your arsenal for growing your hard-earned money. You may have questions about what cryptocurrencies are, considering how abstract the concept is. Digital money? The idea of something that appears to have no actual physical presence in the world, as well as the mechanisms involved in creating, valuing, and spending cryptocurrencies, are complex enough to make most people scratch their heads. Based on computer science and algorithms, the theory behind cryptocurrency can get quite technical and hold you back. So in this book, the essentials are explained, making it clear and easy to understand. Why you might want to invest in cryptocurrency. You've clearly heard of regular people becoming millionaires with cryptocurrencies, particularly Bitcoin, but don't know where to start or whether it's even a sustainable investment. People with little or no trading experience have managed to earn a substantial amount of money from it, and you may be wondering if the hype is over. There have been several critics with skepticism towards the currency and its future place in society, so it is understandable that you would like to do a bit of research into it. You may think that you are a bit late to the party to get a good return, but there are many who believe that this is only the beginning. It appears that cryptocurrencies are becoming part of the future of payments for goods and services. At present, several companies are now accepting cryptocurrencies such as PayPal and Xbox, TAEB 2021, while other companies are now at least considering it. Elon Musk also temporarily accepted Bitcoin in payment for Tesla cars before deciding that the crypto would have to become 50% more environmentally friendly before taking it again in the future. Huang 2021. There also has been talk of releasing digital credit and debit cards, with several crypto exchanges such as Gemini and Crypto.com planning to merge over the next few years. This is surely a positive signal for the future of the currency and its role as not only an investment, but as a method of payment and its adoption into society. You may also wish to invest in crypto because you would like to remove banks from the equation. Sentiment towards banks has grown apprehensive and may draw greater enmity if another recession, caused by the pandemic, is on the horizon. In a way, it does seem that cryptocurrency could be a good barrier against the effects of inflation and a decent way to keep growing your money. In fact, the patterns in cryptocurrency over the last few years have been quite positive and definitely have the potential to give you a great return. What is confusing about cryptocurrencies? There has always been a lot of conflicting information surrounding cryptocurrencies. Large investment firms had once condemned digital currencies and then a few months later appear to be adding them in large amounts to their portfolios. At various stages, institutions have warned against investing in it, yet at the same time we hear success stories from people who purchased them and multiplied their capital tenfold. All these contradicting sentiments are most certainly confusing for a potential investor. Obviously, any investment has an element of risk involved, but cryptocurrency is different to others as it is largely uncharted waters. Cryptocurrency can be risky, as it has been proven to be a relatively volatile market, but as with any investment, the larger the risk, the larger the potential reward. The more information that you can garner regarding the various currencies, the less risk you will take, and the more that you will learn how to spot excellent opportunities to profit. There are over 10,000 different types of cryptocurrencies available to purchase online, and although the choice is a testament to the popularity of them as investments, that choice can be overwhelming. Particularly if you wish to invest a reasonable amount of money, you should, of course, want to make the best decisions possible to minimize the risk to your nest egg. How can you tell when a currency is new to the market, will at least hold its value and not tank overnight? Add to this that the terminology describing cryptocurrency may be rooted in computer coding and math, and it is no wonder that most people would feel a bit alienated by the subject. What you will learn here. This book will give you enough information to build your cryptocurrency portfolio with confidence. Not only will you understand the fundamentals of what cryptocurrency is, how blockchain works, and the various technical mechanisms involved in buying, selling, and distributing crypto, but you will also learn ways to begin investing in it. Here you will be given a step-by-step guide to choosing a digital wallet to store your investments, on whether to work with a broker or an exchange directly, and how to select what tools best suit your needs. The last stage of this book deals with the actual trading elements involved in your investments, teaching you about what considerations to bear in mind when selecting a particular currency, how to read trading charts, and how to use this information to make the best investments possible for yourself. This book will give you all the essentials that you need to start your cryptocurrency journey and enjoy an exciting ride. Chapter 1. What is cryptocurrency? Cryptocurrency is a digital or virtual currency that is run on a decentralized system or network. Like a regular physical or fiat currency, it is meant to hold worth and value and to be used for buying and selling. Apart from the fact that it is not a currency that you can simply hold in your hand, it is meant to emulate the function of normal money. The value of crypto comes inherently from the willingness of people to invest in it. In other words, the more people that see its potential as a store of value, and the more likely it is to be adopted as a method of payment, the more likely it is to increase in worth. The decentralized nature of this means that crypto is not controlled or monitored by institutions or governments. Instead, it is distributed over a large network of computers, meaning that no one authority is in charge of it. Even the prefix crypto means secret or hidden, which references the anonymous sharing of data pertaining to the currency, its transactions, and its ownership. This chapter briefly discusses 10 of the main cryptocurrencies, their history, and describes some of the different functions of cryptocurrencies and tokens. The top 10 cryptocurrencies in brief. The top 10 cryptocurrencies will always be changing, but at the time of writing, there are several that are on top, or at least have great potential for the future. Here, there are examples of a variety of well-known coins with different functions, which are important for you to know about. They may not all be necessary for investment, but are definitely worth including here to illustrate the different varieties of digital currencies currently available. Bitcoin. We simply cannot discuss cryptocurrencies without first looking at the success story of Bitcoin. Started in January 2009 by an unknown creator with the pseudonym Satoshi Nakamoto, Bitcoin was the first of its kind. A pioneer in peer-to-peer and instant payments technology, the coin has been on a roller coaster ride of excitement and highs and lows, reaching nearly $60,000 in May 2021 before suddenly correcting or averaging out to a less extreme value to just over half the amount. The coin is also a finite source, which means that only 21 million coins will ever exist, with over 18.5 million already in circulation. Hayes, 2019. The most famous cryptocurrency has gained plenty of loyal followers and investors, and while sentiment about it, like most other cryptos, has been divided on it, it seems that it will be around for a long time. Litecoin. Litecoin has been around since 2011 and is another decentralized coin that has seen great success in recent years. Started by engineer Charlie Lee, who has worked for both Google and Coinbase, the coin has the 9th largest market capitalization. Like Bitcoin, Litecoin has a finite number of coins for circulation. However, at 84 million, it is considerably more. May 2021 saw the currency reach its highest value of $384.67. Statistica.com, 2021. Ethereum. Ether is now considered the second largest and most successful crypto, peaking, at time of writing, at $4,141.99 in May 2021. Brown, 2021. Created by developer Vitalik Buterin, it began trading in July 2015 and has always mirrored the growth pattern of Bitcoin. Like many other cryptocurrencies, it runs on blockchain technology, but unlike others, there is no cap on the amount of Ether that can be in circulation. Ether's performance recently has also led many to believe that it will eventually even overtake Bitcoin's success. Investopedia.com, 2021. Ripple XRP. Ripple and its currency XRP have been around since 2012. It uses its own blockchain system called Ripple by a company, funnily enough, called Ripple Labs. The system uses a digital payment network with XRP blockchain, which is a different system to regular blockchain mining, making it a token currency. This means that it uses bank-owned servers for transactions. This technology uses less energy than Bitcoin, has smaller transaction fees, and has an extremely fast confirmation process. The highest that XRP has reached was $2.28 in December 2017. Ripple price history, 2013 to 2021, ND. Cardano. Cardano is a cryptocurrency project that was created in 2017 by engineers and academics and launched by Charles Hoskinson as a rival to his former employer, Ethereum. Its currency, ADA, relies on peer-reviewed research and is primarily concerned with identity management and tracing data. Cardano operates on a more sustainable system called proof of stake, which is concerned with reducing the environmental impact of crypto mining on the environment. In May of 2021, Cardano hit its all-time high of $2.20. Cardano Price Index, CoinDesk 20 ND. Dogecoin. Started in 2013 by Jackson Palmer and Billy Marcus, this cryptocurrency was based on a meme and uses the same technology as Litecoin. Despite it initially being a joke, the coin has had reasonable success with even Elon Musk tweeting about its strong potential for the future. The crypto has a loyal following online, as well as an unlimited supply and low price. Its highest price to date was 64 cents in May 2021, with several extreme fluctuations since then. Dogecoin Price Index, Real-Time Dogecoin, Doge, Price Charts, ND. Bitcoin Cash. Bitcoin Cash is an offshoot of Bitcoin, or what is known as a fork. This means that it is a split-off of the currency that has resulted in a new and different version of the coin. The main difference between Bitcoin Cash and the original Bitcoin is that there are more transactions in a single block of Bitcoin Cash than regular Bitcoin. Amari Sachet, a former Facebook engineer, started the project in 2017 that has successfully grown to $1,528.42 at its top price in May 2021. Bitcoin Cash Price Index, CoinDesk 20, ND. The coin split again in 2018, creating Bitcoin Cash ABC, which is now what Bitcoin Cash is referred to, and Bitcoin Cash SV, Satoshi Vision. Stellar. Created in 2014, Stellar uses the cryptocurrency Lumens. Ripple Labs' Jed McCaleb created this payment system, which has been argued to have been extremely stable between 2019 and 2020, and has also increased an impressive 226% from January to March 2021. Investopedia, Rakesh Sharma, 2021. Like Ripple, it connects cryptocurrencies with banks, but it's open source, meaning that its platform is free to download and share and is not a source of profit itself. Tether. This currency, which started in 2014, was one of the original cryptocurrencies that had its price directly linked to the US dollar. This is what is known as a stablecoin, meaning it is considered less volatile because it is tied to a physical fiat currency. It is also the biggest of its kind on the market at the time of writing. The coin is mostly used for exchanges and allows for low-cost, speedier translation and is not so much used for investing itself. It is more of a tool for strong value and for investing by allowing the fast purchase of crypto and removing transaction costs, as opposed to converting dollars or other currencies to crypto. It has been argued that in the future, the cryptocurrencies that will be the most likely to succeed will be stablecoins like Tether. However, as these are not an investment, this relates more to its adoption as a replacement to fiat currencies. Chainlink. Founded in 2017, Chainlink is a cryptocurrency that works in a similar way to Ethereum. Its major difference, however, is that it aims to support blockchain-based smart contracts or programs stored on a blockchain that automatically run when needed and incentivize their use. Essentially, it provides external information to the blockchain database to help them execute these transactions, saving them time and money. At its peak price in May 2021, the currency was traded at $51.24. Chainlink Price Index, CoinDesk 20, ND. The different types of cryptocurrency. Coins. A coin is simply a single unit of cryptocurrency. While it is possible to own less than a whole unit of a digital currency, these are viewed as a percentage of a unit. For example, a whole Bitcoin is one coin, and anything less than that is divided into satoshis, which are valued at 100 millionth of an entire coin. Stablecoins. As mentioned above, Tether is the most popular and famous example of a stablecoin. These are tools that can be used to make transactions on cryptocurrency exchanges easier, as they are a store of fiat currency value and linked to the value of the dollar. It is easier to have these in your account to purchase crypto instead of converting dollars. Some exchanges will also not allow you to directly invest into cryptocurrencies unless you are trading a digital currency in its place, but will accept a stablecoin. In other cases, if time is of the essence, it is much easier to have a store of stablecoins in your wallet ready to trade with, especially when they also can incur less fees for you when depositing or withdrawing them. Tokens, NFTs. If you haven't already, it is inevitable that you will hear the term NFTs thrown around from time to time. Anything from artwork to services, anything worth value and that can be digitally stored, are non-fungible tokens. Although again, this concept sounds quite abstract, it is indicative of the digital direction that society, art, and wealth are taking. However, a token depends on a cryptocurrency to maintain its value, and a cryptocurrency can exist independently. Altcoins. Anything other than Bitcoin is considered an altcoin, as Bitcoin is still seen as the main cryptocurrency giant. These were all launched after the original crypto, with plenty claiming to be a viable replacement for Bitcoin in the future. Chapter 2. What is blockchain? Launched in 2010, blockchain is the way in which cryptocurrencies are organized into a block, surprise, surprise, of connected information. Each block has a number of transactions contained within it, holding a variety of different data regarding the currency. As each transaction occurs and is verified, it is recorded into the blockchain, or rather a shared network. Think of it as a large record block or ledger to visualize its quite abstract function. The easiest way to understand blockchain is to imagine a series of blocks chained together. Each block contains specific information, and they are chained together in an order according to that information. Consider how books are alphabetized in a library: AA, AB, etc. Each block has a similar information to the one before and after, which is the chain that connects them. The idea behind this is to protect the information from being hacked or stolen by outside entities. If, for example, the letter D appeared randomly in the A section of a library shelf, if there are enough librarians on duty, it is easily noticed. The same applies to blockchain, where everyone with the equipment has equal access to the information, making it easier to spot inaccuracies. Blockchain uses a huge database that stores data together in blocks. When new information enters the system, it is presented as a block. The information that they contain, which may vary from crypto to crypto, can be broken down into two types: information that keeps the chain safe from hackers, and transaction data such as digital addresses and how much has been sent. The transaction data is usually anonymous unless it is linked to a specific registered exchange. This means that personal data is kept secure through blockchain. Blockchain operates on the basis that it wishes to foster trust in its community by sharing the information with everyone on one large network. Because this information is secured and easily identifiable, but also in full view of everyone, it has gained more trust from investors and coders alike. As it is shared across a large network, no one person is in charge, so the entire operation is transparent and democratic. This also ensures that no one on the network can steal from it or gain an unfair advantage regarding the currency. This is why blockchain uses a digital transaction ledger, or DLT. The digital transaction ledger. DLTs have also been used by various financial institutions in the past for similar services, so these are not unique to blockchain. This established technology involves sharing information across a whole network that is managed by many people at the same time. The main features of the ledger that are particularly applicable to cryptocurrencies are manifold, but can be boiled down to the following key areas. The technology is programmable. Blockchain operates by doing multiple things at multiple times in multiple places. In other words, it does not work on one task at a time in a simple linear fashion. For this to happen, it is necessary for an automated program to run, conducting several different types of transactions at the same time and record the necessary data. This data is then shared with all participants in the network as well. In order to keep up this level of work and intricate level of recording keeping, it is essential that the ledger be programmed to automatically respond appropriately to each type of transaction, of which there could be thousands of at a time. Without this technology, blockchain would not be able to function. Distributed. This means that all information is shared across a wide network of people. Everyone can have access to the same amount of information once they participate. This not only makes the system safer as information is not stored at one singular point, but also allows for a more democratic approach and easier access to information. Immutable. When transactions on the chain have been authorized and validated, the process is finalized and cannot be reversed. This makes it tough for a hacker to interfere with the chain, as they will also find it incredibly difficult to rewrite the information retrospectively. Timestamped. Information related to transactions on the chain and the time that they took place is also captured and stored. This then shows the last time the information or data has been accessed, created, or modified, making it even more secure. Unanimous. The democratic nature of blockchain means that all participants have to agree with the information that is validated. This shared information and again goes back to building trust between all those on the network. Anonymous. Information shared on a blockchain is not directly attached to the individual transactions. Participants are mostly protected and identifiable unless their details are linked to the exchange that they use for their transactions. Secure. All transactions on the block are encrypted, which will be explained later, but for now, this means that they are hidden in code to protect them. The chain is also sequenced in such a way, with all the elements of the data so tightly linked, that it makes it very difficult for it to be hacked without notice. The fact that blockchain also has many people involved in one network means that it is more secure, with more people equally sharing and staying vigilant. Hacking and blockchain. If one block in one chain is modified due to external interference, it is quite easy to tell that it has been tampered with. One of the reasons for this is that the hashing algorithm, or how the information is assigned to the transaction, although unique, is similar and sequentially ordered with the previous block. This data cannot be reversed or rewritten. If someone attempts to interfere with the algorithm, it is difficult for them to alter the data because it will be noticeable in the overall chain. Each link would change each part, and a hacker would have to change many parts in the link to align it correctly. In other words, for hackers to actually achieve anything, they would have to rewrite every part of the data of the surrounding blocks in order to keep them in sequence and not attract attention. This hardened security makes it nearly impossible and pointless for them to even attempt in the first place. As an additional roadblock for hackers, in order for a transaction to be validated or allowed on the network, 51% of the computers must agree on authenticating it. Vermac 2020. This means that a hacker would need to control at least that much of the system to agree with them. That in itself is difficult, but if successful, this would mean that they are in control of 51% of the cryptocurrency. This may sound frightening, but this would also be obvious and not a stealth attack for the hacker, as the remaining coins would skyrocket in value, eventually crashing the market and leaving them with worthless coins. Decentralization also helps by providing transparency and allowing for participants to notice issues with either security or equipment. There is no one source for the database also, which means that there is not simply one point of entry if there were to be an attack or issue, and that it can be easily noticed across the network in several places. To use the analogy from earlier, if an author with a Z surname suddenly appears in the B section of the library, slowly changing the books around them to Z books also, it wouldn't be long before one of the many librarians noticed. Chapter 3. What is cryptography? Cryptography, or the study of secure communications techniques, has been around for centuries. The simplest example of this would be the sending of coded messages between spies in different countries during times of war. The overall definition of it is when a secret message is sent to another with the intention of only the recipient receiving and understanding it. Both the sender and the receiver have the key, or the manual on how to read the code. This is also directly applicable to cryptocurrencies, where only senders and recipients can view the contents. In the case of cryptocurrencies, this is needed for transactions, as in buying crypto or sending it to an address. Transactions need to be passed directly from one to another with no external interference. For example, you may purchase some Bitcoin and want to add it to your own virtual currency wallet. But in order to do this, you will need to be able to send that information safely and securely through coded data that cannot be read or intercepted by anyone else. In order to prevent your cryptocurrency from being stolen, complex algorithms are used to encrypt data in coded messages so that only the sender and receiver can view the contents. This secures your data and prevents anyone from stealing from you, as permission is required to gain access to it. These are encrypted by using private and public keys and are needed for both your digital currency wallets. This chapter explains how public and private keys work and gives a brief overview of how they work with wallets. Private and public keys. Your public key is a digital address that you can receive transactions on. In order to open or unlock your transaction, you will need your private key. Your public key is paired to your private key, which only you have access to. You can share your public key with whomever you wish to without issue. It is nearly impossible for someone to work out your private key from that information, but you should never share your private key with anyone. If someone has your private key information, they will be able to access all your funds and even move them elsewhere, so it's important to keep them secure. A public key is a condensed or hashed version of your actual digital wallet address, where you hold your crypto, that looks like a bank account number. Your private key, however, is a randomly generated set of numbers and letters that is related to the public key and identifies you as the owner. Your private key unlocks the public key so that you can receive your money. It basically is a digital signature confirming that you have received the funds and that you are the rightful owner of the transaction. This information can also be verified by blockchain, which does maintain some level of security. Perhaps the easiest analogy to use for this is using an Airbnb service when on vacation. Your host may leave the key for you to collect from a key collection service. Everyone can see where the key is stored, but only you have the code to access it. If anyone else gains access to the locker where the key is, they can simply let themselves in your room for the week and make themselves at home. It is important that you understand that not all exchanges and broker services will give you these keys, as they are more custodial in nature. Some do not allow you to transfer your crypto elsewhere and hold it on your behalf. This means that you do not control your own security or your own funds. If this is the case, and you still choose to use them, please ensure your funds are secure in other ways, and that the company that you do business with has a good reputation. Technically, if you do not own your own private key, it has been argued within the community that you do not actually own the crypto. There are several forms that your private key can take, including a scanning QR code that you can use with your phone, a 64-digit hexadecimal code, a 256-character-long binary one, or a mnemonic phrase seed, which is a list of 12 randomly generated words. You can access your keys in the settings of most online wallets, and you can also set your own 12-digit keys for your actual wallet too. The beauty of these keys is that it means that you can gain access to your account anywhere in the world by using them. Potential problems. The system is brilliant in that it is secure and easy for an individual to keep their money safe. However, this can also go the other way as well, making it so safe that even the owners cannot get near their own money. There have been several stories of people losing their private keys to access their Bitcoin in recent years. German Stefan Thomas, who has 7,002 bitcoins, has been unable to remember his key and has 2 guesses left before he is locked out of his account forever. In Wales, in the UK, a man accidentally threw away a hard drive with 7,500 bitcoins in 2013 and has petitioned to search the local landfill site where he believes it still can be found. Frustratingly, both are worth millions now and neither of them are able to access the funds. Onanuga, 2021. Of course, even the best solutions do have their own potential problems. Losing keys can mean that you cannot access your money, so it is crucially important to store this information on paper and in a few different places. It is advised to store it offline so that this information cannot be found and stolen. Once you lose your private key, you will not be able to recover your funds. You may also be able to use a hardware wallet, which is a USB storage device that is encrypted to protect your data. Some online wallets provide a safe storage place on their website for your keys as well, so it is worth investigating. These will allow you to store your private key in a secure way and prevent you from losing the information that is essential to you staying in control of your money. Another risk that comes with private keys and your security can come from accidentally revealing the information. Say, for example, someone confuses their private key and public key and even for a second posts it somewhere publicly, or even stores their private key as a draft in an email and the account is hacked. Securely storing your keys in several places is the best way to protect it. Remember to avoid storing it anywhere online that has a potential to be hacked, from your laptop or email to your tablet and phone. If someone works out what the information is, they can get access to the account even if it is only public for a second. In this instance, it would be advisable to move all your crypto elsewhere temporarily and create a new private key to avoid someone draining your account. By and large, the system works very well at keeping your refunds secure, and it is human error that creates issues. Hot and cold crypto wallets. Let's briefly discuss your options with wallets here, as we have already mentioned security and public and private keys above. Recall that wallets are where your digital coins are stored. As we discussed, your wallets will have its own address or public key and should have a private key. Depending on the type of wallet you have, you can have a variety of cryptocurrencies and store dollars to buy or trade more currencies. The 2 main types of wallets, which will be elaborated further on in later chapters, are hot and cold wallets. Hot wallets used online, and they are easier to use but may be less secure. Cold wallets require hardware like a USB device and have excellent security, but are harder to access as you are essentially putting them into cold storage. You will occasionally have to connect them to the internet in order to add or send coins, but for the most part, this will be limited. In Chapter 6, when discussing how to buy cryptocurrencies, we will look at the types of wallets in more detail. Chapter 4. What is cryptocurrency mining? Cryptocurrency mining is how crypto is put into circulation by authenticating the blocks on the blockchain. Mining, as you would expect, means that the coin and its information are extracted, much like gold would be. Miners, simply put, look after the digital ledger, DTL, by sorting out complex coding and mathematical issues by a process called hashing. Hashing is the way in which data and information is assigned to the currency and its transactions. They assemble all the details of transactions together and organize them into tidy blocks of information. New coins can only be created through the mining process also, as they are given to miners as a block reward for authenticating the transactions on a block. Adding each block is the only way to create new coins on the network, and on average, 1 block is added every 10 minutes to the chain. Miners are pretty much the auditors of cryptoland, making sure that coins have not been copied, kept, and sent at the same time by checking for duplicates in the system. They help with the ledger overall, recording transactions and the information that goes with them. This maintains the transparency that is necessary for decentralization to keep the network and currency legitimate and trustworthy. Why do people mine? Miners are rewarded with coins for their work. However, mining is not an easy job to be taken lightly. Firstly, excellent technology is required to create a mining rig or a specialized supercomputer, and secondly, the processing power required to solve the puzzles is huge, which results in high energy costs. Mining has expanded dramatically over the past few years, with the rewards paid out in total for their services totaling over $1 billion a month. Crockett, 2021. This means that the miner needs to be sure that they can make a profit on this, as the upfront and maintenance costs can be expensive. The increase in miners over the last few years has also increased competition, which has meant that originally could be a one-person job requires much more in terms of equipment and energy in order to be rewarded. To get paid, miners need to solve these issues within the blockchain and prove they are the first to work it out. This is known as proof of work, which means getting as close to solving the answer as possible, if not completely. When the problem is solved, the first miner to create the solution claims it. This is then authenticated, and they can get their reward. This also produces new coins, which are sent into circulation. Currently, other currencies are also using another system called proof of stake. This system, like proof of work, allows miners to work on the networks for rewards. Proof of stake, however, is different in that the individual miner or group of miners who holds the most coins or rewards can do the most mining or has the most power. The more stake that they have in the coin, the more that they can mine. This strategy means that theoretically, miners will be unlikely to turn on the blockchain as they have invested interest in it. Proof of stake also has a more positive impact on the environment than traditional mining, as the emphasis is not on mining power. In this way, it is quite competitive, especially seeing as there is no limit to the amount of miners that can be in the operation on the network at any one time, so the chances of being the first to find a solution are vastly reduced. The hashing rate is always the same, which means the amount of new blocks created is constant whether new miners come or go. In turn, this means that the results and rewards are also always the same. Because of this, there can be an increased number of miners competing and attempting to power up their rigs for a better chance to claim the transactions, as the more miners on the network, the less likely they are to solve the problems first. This year, miners have been rewarded with 6.25 BTC per validated block, which is decreased from previous years as the reward is reduced over time with less potential coins to circulate. Eventually, when all coins have become circulated, it is thought that miners will continue to validate transactions and be paid a fee for their work instead of in crypto. Halving and its impact on mining. There will only ever be a certain amount of Bitcoin in circulation as the cryptocurrency is finite. Roughly every 4 years, there is an event called halving that impacts the coin and its value, reducing the amount of rewards for miners. This affects the miners in that there are the same amount of coins being produced and selling at a high value, but the rewards are less for them. However, this prevents the coin from becoming overinflated by keeping the price steadier as opposed to flooding the market and devaluing the currency. This slows down the production of the coins, which results in price increase. In the aftermath of the halving in 2013, 2016, and 2020, the prices of the coins shot up dramatically, followed by an extreme drop to a lower price. The next halving will be somewhere around 2024, which will be a highly anticipated event for loyal Bitcoin fans. The rewards for miners during this period, however, went from 50 Bitcoin in 2009 per transaction to 25 and then 12.5 before lowering even further to 6.25 in 2020. This has prompted miners to pool their resources to invest more time and energy into their rigs, ensuring their mining profits, which in turn has brought up some concerns regarding mining and its impact on the environment. The controversy with mining. Recently, there have been some energy consumption concerns regarding mining. The process is a difficult and expensive one, with multiple participants who all have large, powerful setups running at the exact same time. Think about how hot your laptop gets from just a long day of opening multiple tabs. Imagine that with several powerful computers, potentially all in one room, so warm that they require a cooling system constantly running without ever stopping. The way in which it is conducted has also changed dramatically over the years, as now there are over 1 million miners worldwide, and some no longer operate alone. Increased competition and reduced block rewards have resulted in people improving their operations, buying more powerful hardware, including dedicated mining machines like ASIC to attempt to get more coins, all of which end in a higher consumption of energy and production of waste. For many, it has made financial sense for them to pool their resources and create large mining farms, which use even more energy, and the biggest culprits to impact the environment are Bitcoin and Ether. Bitcoin has recently come under fire for this, and with 65% of miners located in China, a country that uses coal as its main source of energy, the mining process releases a serious amount of emissions. Rife, 2019. Also, as mining is quite intense, there is a tendency for miners to have to replace their electronic equipment more frequently as its lifespan is decreased due to the stress and additional wear and tear on the systems. Mining in China has also been criticized as equipment costs are significantly cheaper there, meaning that their mining pools and farms are more financially viable but can have a huge impact on the environment. The environmental impact of mining should not be underestimated, not only because of the pollution that it can cause, but also on the potential effects that this may have on cryptocurrencies and their value. As a result of this, many cryptos have already started looking into renewable energy sources for the future. Mining is an important part of the peer-to-peer and decentralized part of cryptocurrencies. However, XRP, IOTA, Cardano, Stellar, Nano, and Eosio all use sustainable renewable energy sources. Also, a move away from the power-consuming proof-of-work system on blockchain to the proof-of-stake model desensitizes the use of extreme amounts of energy. One thing for sure is that environmental issues are crucial to the success of crypto in the future. Chapter 5. Entering into the crypto market. This section highlights some of the key areas that you should consider before entering the cryptocurrency market. You have already done your research on the available investments and have learned what to look for when assessing additions to your portfolio. But before you start buying, as with most investments, you need to decide how you will invest your money, for how long, and what may impact your returns. All investments come with some level of risk, and crypto is no different. However, making careful and clever decisions minimize the risks that you are taking. Crypto trading is different from regular investing in a couple of ways. The first is that the market is open a full 24 hours a day, which means that anything can potentially happen while you sleep. Secondly, the market does not follow a conventional trading pattern, meaning that it is difficult to accurately predict what exactly will happen with the currency. Digital cash, which is mostly used for investment at this point, as opposed to purchases, is in its infancy. It is nearly impossible to tell what route cryptos will follow, let alone what any specific ones will. This makes speculation on the crypto market, no matter how calculated, risky. Thirdly, it is volatile and can go from quickly extreme highs to extreme lows before correcting itself. If you have not traded before, you may have to adjust your mindset somewhat. Remember that investments are decisions that should be ruled by the head and not emotions. In other words, when you are trading, do not allow yourself to react suddenly and impulsively to what is happening with your cryptocurrency. Keep in mind that these currencies can jump from extreme highs to extreme lows in a matter of hours, and not to suddenly cash out without being objective. Emotional trading could lead to selling off your investments too early and finding the next day that they have increased exponentially. With the correct mindset, what could be considered drawbacks for some become opportunities for others to buy into the market. Define your goals. The first step in investing is to decide what your goals are for your finances. Do you have a specific plan for your investments? Perhaps it is for a vacation or even a wedding. Cryptocurrencies may be quite unpredictable, so it may not be the easiest plan for the future with them, but they can be useful if you are looking for investments that are not time-dependent. It is possible to trade short and medium term in cryptocurrency, but the risk is minimized the longer that you leave your investment there to grow. Crypto is most certainly not your traditional investment, and it could potentially form part of your investment portfolio, but it would be quite risky to base your entire retirement around it. Many people who invest in cryptocurrency do so for the long term. You may have seen the term HODL used in online forums amongst the Bitcoin community. This comes from a spelling error of the word hold, which has become a motto for many long-term investors in the coin. For example, in the case of Bitcoin and Ether, two of the longest established coins, The long-term growth of both has been huge, as Bitcoin cost a mere $426.84 and Ether $7.10. Statistica 2021. Patience appears to be a virtue with cryptocurrencies, so now more than ever it is vital to pick well for growth. Many of the HODL followers are quite optimistic about the coin, and even in times when the value has significantly dropped, simply refuse to cash in. For many of them, this has worked out exceedingly well, as the coin's price has often bounced back even higher than before. Technically, you have not lost any money until you withdraw it at a loss, and for many invested in crypto, this is a mindset they seem to have adopted. The beauty of these long-term investments is they have plenty of time to increase, so a relatively small amount of money can impressively increase with little risk for you. Deciding what way you would like to invest. Do you want to invest a lump sum, on a monthly basis, or both? Investing a lump sum means that you will need to identify a decent entry point in the market by studying charts and statistics, but it is possible. Having a defined monthly crypto deposit can even out and reduce the risk with fluctuating prices, but may incur more fees. Doing both is an equally viable option. The healthier and more diverse your portfolio is, the less risk you incur. Have a clear idea of what you can afford to invest, taking into account the various fees and taxes involved. To make sure that you get the most out of your investment, ensure that the money you use can be committed to your investments for a long period of time to minimize the losses that you may incur withdrawing it prematurely. Even a small amount of $200 when invested correctly and for enough time can develop into a more substantial sum, so remember that no investment is too small. For example, albeit an extreme one, Dogecoin was worth 0.0054 cents on January 1, 2021, and after a roller coaster of highs, finally corrected in July to between 32 cents and 38 cents. That means if you had invested $200 in the coin in January, this would now have grown to at least $11,851.85 before fees and taxes. So in some cases, the amount that you have invested can increase exponentially. Doing some research. To assess what is an acceptable return on your investments, you need to factor in other costs. Remember, your initial returns will be gross, not net, and there will be deductions that will reduce your profit. For example, most investments incur capital gains tax on profits, and other taxes may also apply depending on where you are located. Swapping currencies around can also incur these taxes as well, so consider this before moving your crypto unnecessarily. Depending on the exchange or broker that you use, you will also be subject to fees, so remember to research those. Again, if you receive a payout into your bank account or PayPal, there may be fees involved there as well, so please do investigate these based on your specific needs. Ask yourself what return after taxes and fees would be acceptable. The smaller your investment, the higher the return should be before you attempt to withdraw it to make it worth your while. There is absolutely no point in cashing out a healthy profit to have it nearly completely absorbed through fees, taxes, and transaction fees. Depending on what services or type of wallet you use, you can set alerts to let you know when your crypto has reached a target price, as well as which can be handy if you are trying to invest for a shorter term. Looking at the market overall. It would be a lie to say that the market is predictable and easy to follow. In fact, it is quite volatile and has so many variables driving it that part of the whole process is simply down to luck. However, there are some good indicators that can give you an idea of when there may be good opportunities to invest on the horizon by getting a feel for the overall sentiment expressed in the markets. Reading the news, for both stock market and crypto, will give you an idea of how optimistic or pessimistic the market is. Is the market down overall? How is the crypto market faring against the stock market? How strong are fiat currencies at the moment? Bear all this in mind when looking at the charts for various cryptocurrencies and decide whether you think the overall market is bullish or bearish. A bullish sentiment indicates that prices are currently in an upward trend and may continue to increase. A bearish or pessimistic market attitude could mean that prices are lower or resistant to increasing and are in a low cycle. Bearish, although sounding grim, can present a good buying opportunity at decent prices, depending on where in the cycle the currency presently is and how long you are willing to invest your money. Chapter 6. How to buy cryptocurrencies. This chapter shows you how to buy cryptocurrencies in an easy-to-follow way because investing does sound pretty complicated. However, as cryptocurrencies have become more widely accepted, the process has simplified, having more in common with traditional forms of trading as time goes on. Here, each of the main steps involved in investing is explained, from setting up your exchange and choosing your wallet to payment methods and cashing out. Before you start, you may need photographic identification, a strong and stable internet connection, a debit card, PayPal account, or credit card, an email address, an external wallet for extra security. What is a wallet? We have already touched on what the purpose of a wallet is, and that it is needed as an extra level of security for your money. Although blockchain is extremely difficult to hack, your wallet is more susceptible to attack. While many exchanges do have their own integrated wallets, it is much more prudent for you to have your own external storage. While your private key is secret, the transparent nature of blockchain does allow people to see how much Bitcoin is held by a certain public address, or at least was involved in a large transaction. To be extra safe, it is better to store your money at an address that is not associated with the public address that you use to buy crypto, especially when you used your ID to set up your exchange account in the first place. There are several different types of wallets available that fall within the remit of hot and cold wallets, and getting a safe and secure wallet should be your first port of call before buying anything. Online web wallet. This allows you to access the wallet through a browser on your computer or laptop, but you should never store all your cryptocurrencies into these, as these are less secure. Many platforms offer these as a part of their interface, and whilst they are handy for quick transactions, they are vulnerable to cyber threats and hackers. It is also possible to manage a portfolio of cryptocurrencies from one place, which again may be convenient, but unless your investments are relatively small, you should consider moving them elsewhere as soon as possible. You can, of course, add another layer of security to these, depending on your provider, by setting your own keys and using two-step authenticity, but cold or offline storage is advised to deliver optimum security. Mobile wallet. A mobile wallet, like a web wallet, can be downloaded and installed on your mobile device. In order for it to function, the internet is required, which opens you up to more security risks, particularly as mobile devices can share Wi-Fi data with anyone on the same network. They are extremely useful, however, as they can be used to make payments in shops and can transfer coins through scanning QR codes. Desktop wallet. One of the more secure ways to store your coins is with a desktop wallet. This involves downloading the wallet to your computer hard drive, using the internet for the transaction, and then keeping the wallet in offline mode. Having a private key and not losing it are extremely important in this case, but this form of storage provides excellent security. You can also purchase a hardware wallet for your desktop, which looks similar to a USB drive, making your crypto wallet very portable should you need it. These are also very secure. You can also store your keys separately on these to ensure that you will always have access to your cash. Setting up your wallets and exchanges. Setting up an online or offline wallet is extremely easy and will often be integrated with the exchange platform that you choose to use, so you can set them up at the same time. Most of these were created with a novice in mind and are meant to be customer-friendly. Once you have decided what type you want, you will need to begin the sign-up and download process. Most of these will have a simple step-by-step instructions and will be easy to follow. You may need to download software to your phone or computer, provide email verification, photo ID, and a payment method. Some exchanges may require you to take a selfie. The identification process will not be instant in many of these cases, so you will not be able to buy currencies straight away. You may need to set up both online and offline wallets at the same time, so when you buy coins in your online account that you can send it to your offline one straight away. In the meantime, before you top up this account, you should visit the settings, take note of your wallet address, and create or generate a key with two-factor authentication. You should then take note of these and store them securely offline in multiple places. Some wallets will offer you the option of using a series of words to set as a key, which is far easier to jot down than a series of digits. Once you receive notification that your account has been verified, you are ready to top up. Topping up with your exchange. Now, you may have already picked your exchange with the integrated wallet at the same time as making your offline wallet, so you will already have used your identification to set up a verified account. Before you pick your exchange, you may need to examine what payment methods they accept and whether they meet your needs. It is also a good idea to find out how your bank deals with cryptocurrency transactions, as many transfers in and out of your account may cause them to suspect fraud and block them. Each exchange will accept different payment methods, with some accepting PayPal, debit cards, bank transfer, and credit cards. The best way to top up your account is pay by either transfer or debit card. Credit cards usually end up costing more in transaction fees. You should look closely at the fees that are charged through your bank and exchanges for the purchase of cryptocurrencies. There can be flat-rate percentage commissions that can vary depending on what method you are using. PayPal does allow for the purchase of Bitcoin, Bitcoin Cash, Litecoin, and Ether, but this means that your money is tied to this payment and cash-out method, which may not always be suitable. Once you have chosen your payment method and added it to the exchange, in most cases you will simply have to click on the currency of your choice in the exchange and follow the instructions. Once the currency has been converted in your exchange, you can then click on that and follow the instructions again to send the funds to your other wallet. There are also many tools offered on exchanges that automatically purchase an amount of crypto for you on a regular basis, should you wish to use it, along with, or instead of, investing a large lump sum in one go. This is called the dollar cost average, as it averages out the cost of a volatile asset, as it can be difficult to identify when there is a good time to purchase crypto. This system can also work in reverse on certain exchanges for payouts. A user can decide on a price that they would like to cash out at, and by how much, and it will be automatically done and deposited into your account. Cashing out will be nearly the exact opposite of topping up your account. You will simply send your crypto back to your exchange wallet, click into it, and sell before choosing the method you would like to be paid in. Time for this can vary, but make sure that you receive a confirmation email. Make sure that you document each transaction clearly, particularly payouts, as you will eventually need these for tax purposes. It is inadvisable to avoid paying tax, as most exchanges can and will pass on information anyway, as you are verified. Plenty of exchanges have a range of downloadable documents and statements for you to make it easier for you in the first place. Chapter 7. How to set up your portfolio. Knowing which cryptocurrency to put in your portfolio can be difficult in the beginning. This chapter aims to give you a firm nudge in the right direction on how to select the right cryptocurrencies for you. Making good decisions early on in investing is a lot simpler when you know what you are looking for in a currency, and with so much out there and so much information to choose from, it can be hard to identify which are wise to include or not. This section gives you some ideas on important aspects of currency that point to it being a viable investment, and briefly covers some of the key trading terms that you should understand to measure their performance. It is suggested in most investment scenarios that having a diversified portfolio is the best approach to minimizing risk, and cryptocurrencies are no exceptions. Having your fingers in a few different pies also allows you to take some risks, which can pay off more than your safer options. Although cryptocurrency is still considered quite volatile and its future trajectory unpredictable, it is advisable to include some more established coins like Bitcoin and Ether in your portfolio, along with some newer but potentially riskier altcoins. Some currencies and their value also have a strong correlation together, and this information is available on both crypto apps and online. This indicates which coins' performances are tied together and how tight they are linked. For example, if two coins or a coin and a token have a value closely linked to the other, their value will increase or decrease together. This leaves you with a less diversified portfolio and results in more risks, as if one of your currency loses significant value, the others will as well. Finding a new coin, particularly when it is in its infancy and relatively cheap, can be a fantastic investment opportunity if you are willing to take a risk. but how can you choose which new coins to add to your portfolio? What to research when looking at altcoins? The purpose. Most coins have a purpose of some sort. Perhaps they are offering to fill a gap in the market with smart accounts, offering sustainable crypto, or to add value to digital art. Whatever their purpose, you need to identify what it is and whether you feel that there is an actual market for it. Are there many other cryptos offering to do this? Is this a trend? Is the market already oversaturated? Do you think it is a useful coin? When you have answered these, you then need to examine the company, its size and reputation, and assess whether you believe it has the solutions and means to fulfill those needs. Impact, community, and reach. Online communities can help or break a new currency, and assessing where it lies in the community and how much the coin is being spoken about are a good indication of its following and future success. Remember that Dogecoin was only ever supposed to have been a joke crypto, and now is doing relatively well. Well, this was in part due to online forums and community support. Sites like Reddit are excellent for gathering information on public opinion on each coin as well. Also, check out their social media accounts and website to see how much they post and engage with the community. What is their mission statement and how well planned out is it? Does it seem like they are moving towards their goals effectively? Are they very active? Does the coin seem to have substance? All of these are key indicators that a coin is useful with a loyal following. Who are their investors? Look into who the key investors are in the coin. It doesn't necessarily matter whether these are famous investors or not, although that can be a great signal to buy, but at least research if they are strong and experienced in certain areas. Check out what projects they have worked on previously and what they have succeeded at. If investors have been involved in well-performing coins or tech companies before, this adds to the feasibility of a potential investment. Media attention and hype, and how this impacts on crypto. Elon Musk's tweets about Bitcoin have resulted in a lot of emotional sell-offs of the currency. Celebrities seem to be very opinionated on the matter also, which has had an impact on the prices of coins, despite the fact that they have little experience in trading. Look at large investment companies like JP Morgan and see if they have recently spoken about them. Cryptocurrency differs in that many of the investors have no experience in trading and are not doing it professionally. Arguably, this does mean that it is a more relatable way of doing business, but it also means that a lot of those involved are in no way experts. Take heed more of financial advisors and companies, bearing in mind the fact that they will likely want to cover their own investments as well. Looking at who is investing in what, and if possible, find out how much of their portfolio is invested with specific cryptos. Public sentiment and trust in a particular currency, as well as its following online, can have a massive impact on its public perception and price. Look at the recent trend on Reddit regarding the stock market with GameStop and AMC, and the price increase on those shares based purely on public demand and focus group mentality. Charts and what they can mean. Charts can be confusing, especially when they are only for a year-old crypto, which is why the other variables listed above are valuable in making an assessment on whether to include a currency in your portfolio. The specific information that can be garnered from the statistics and figures included on charts will be addressed in more detail in Chapter 11, but it is important to consider them before investing. These will help you decide on a good time to buy, or entry point, as well as when to cash out, or what is known as an exit point. First, it is possible to identify cycles in charts that span over a few years. For example, each time there was a halving event with Bitcoin, there was a massive price increase in the months after. Every time this happened, the price grew higher than the last. Whilst this is by no means a guarantee that this will happen again in the future, all factors indicate that this is highly probable, depending on other variables. Other noteworthy events include a new coin's release across different platforms. There can be a quick surge in prices in the immediate aftermath of its debut, and whilst it is not necessarily indicative of the real value after the hype has subsided, it can serve as an interesting short-term investment where you could potentially see a 50% increase in your investment in a short period of time. You will also notice that certain companies who state they will begin to accept cryptos as a form of payment will have an impact on their performance, even if it is only in the short term. Keeping an eye on any news that pertains to cryptocurrencies will help you read charts and intuitively develop a sense about prices. Some of the main data available on charts that you should be particularly interested in when contemplating including in your portfolio are market capitalization. This is calculated by the amount of shares, or in this case coins, that are currently on the market multiplied by the value of each. Comparing the market cap of coins that have been around for a similar period of time gives you an idea of how strong the current market is. Circulation. Circulation indicates how much of the currency is in use in the market. Many cryptos may be unclaimed for a variety of reasons, including lost keys or crime, so it's important to look at how much of the currency that is mined and available is moving around. This is a more accurate way to gauge the currency. Another way to look at a more specific information regarding circulation can be to look at the data regarding the length of time the currency is held for. Apps such as Coinbase have the information freely available, although this is only relevant to the usage on their site. However, working out how long on average people are holding their currencies for and what percentage of people are buying and selling on a given day is a fairly good barometer for its popularity also. Time in the market. Particularly of interest, looking at younger altcoins will give you an idea of how long a crypto has been in circulation. When you cross-reference this information with performance and market capitalization, you can get a really accurate picture of public sentiment, practicality, and potential shelf life of the coin. Even if the coin has only been available for less than a year, steady growth during this period is a positive indicator, especially if its cost is low. Chapter 8. The difference between brokers and exchanges. Once you have decided to take the crypto plunge, the next step is to decide whether to go with a broker or exchange to buy and sell your currencies. Both of these platforms fundamentally offer the same things, yet at the same time there are some substantial differences. The main difference between the two is that an exchange organizes direct transactions between people who wish to trade currencies, while a broker is a middleman. Whether you decide to go with a broker or an exchange, you will need to first check that the company has a good reputation. Ideally, they should give you public and private keys to your wallet, giving you full control over your investments, and allow you to set your security keys on your wallet. Each exchange and broker will offer different features, with some brokers having many similar features to exchanges. It can be a bit confusing trying to work out which is which, particularly as within exchanges there are both centralized and decentralized offerings, which offer somewhat of a hybrid service between brokers and exchanges. The easiest way to explain is that a broker will serve as a middleman between you and your cryptocurrencies, simplifying the whole process, but, as a result, has control over setting the price. An exchange, on the other hand, allows you to trade directly with other crypto owners at market values, but this is more complicated, especially for new users. This chapter looks at how both of these work and their differences to give you an idea of what may suit your specific needs. The role that both brokers and exchanges have in crypto will be explained, highlighting their pros and cons, before finally examining some specific examples of companies out on the market at the moment and looking at their features. Brokers. A crypto broker works very similarly to a traditional broker in that they act as an intermediary between you and buying cryptos. They set up the exchanges and take a lot of the responsibility away from the trader. Because they do this, however, they decide how much the currency is worth and charge more fees as a charge for their work. The pros of brokers. Usually, brokers have a good online storage for your funds, which are convenient to use and insured. Most brokers offer a variety of payout options, ranging from bank transfer to PayPal, which means that you can withdraw money quickly should you need to. Brokers aim to make the service as user-friendly as possible and make it easy to deposit fiat currency into your trading account. Signing up with a broker is a straightforward process, usually involving an email address and verifying your identity with a photo ID. Most brokers are well regulated and are insured, which means that if anything should happen to your funds via the site, that you are protected. Because it is so quick and efficient to buy and sell through these platforms, they can be used for short and medium-term investments as well as for longer periods of time. These are the simplest way to get into cryptocurrencies if you are a beginner and have a limited knowledge of trading. The cons of brokers. Although you have invested in crypto, most brokers do not give you private and public keys, so you do not have a lot of control of your coins. This has been argued to mean that you do not actually own your cryptocurrencies. In the past, brokers have restricted trading on their app due to high-volume trading. Most brokers do not give you the option of moving your cryptocurrencies to your own wallet for safekeeping. Although most brokers are well regulated, they are not as secure as exchanges. Brokers charge more in transaction fees and set their own more profitable rate for each of their trading options. This means that not only will you be making less of a return on your money, but that your fees will be higher. Examples of brokers: Robinhood. Features: easy interface, web and mobile trading available, simple and fast setup. Fees and costs: free trades, $75 for cashing out, $5 a month for the gold plan. Pros: good for small investments, easy to access tax and account statements, good for beginners. Cons: limited support, untimely outages and at time restricted trading, limited trading options. Key: no. Security: accounts are covered by the Securities and Exchanges Commission. Verdict: this brokerage account is good for beginners and easy to use, but does restrict the control that a trader may have over their own money. eToro. Features: solid trading platform, allows you to copy a trader's investments, good for beginners and experienced traders. Fees and costs: withdrawal fee of $5. Commission varies from 0.75% to 2.9%. Pros: automated trading tools, low account minimum, advanced cryptocurrency platform. Cons: not available everywhere, can be very difficult to understand statistics on the site. High fees. Key: no. Security: the service is reported to be highly regulated. Verdict: although the site is suitable for beginners and more experienced traders, it can be quite difficult to use. Once a user familiarizes themselves with the features, it does have the advantage of automated trading tools. Bitpanda. Features: large offering of over 53 digital assets, has several educational tools available. Fees and costs: fixed fee 1.49% plus payment costs. Pros: accepts a wide range of fiat currencies, detailed and user-friendly instructions, offers APIS and 24/7 support. Cons: high fees, high payout costs, no insurance. Key: no. Security: no insurance. Verdict: while this platform has some user-friendly solutions and has had a few online complaints about its service, the fact that it has high fees and no insurance is quite concerning. Exchanges. An exchange acts as an intermediary between two traders and allows them to trade with each other in pairs while taking a fee. These trading pairs, such as USD BTC or USD XRP, means that an investor can only sell to an appropriate or corresponding trader. It's like you introducing two friends you know would get along together at a party and asking them for a drink in return on their anniversary. There are two main types of exchanges: centralized, where a third party is involved in the transactions, providing software and storage options that the user signs up to, or decentralized, where the exchange involves no sign-up or details and simply introduces trading partners. Arguably, the most secure exchange is the decentralized one due to its anonymity, but the third-party interface of the centralized platform makes this a much more user-friendly option. The pros of exchanges. Exchanges typically have excellent technical support that is available to help with your trading issues. Exchanges also offer better rates for crypto than brokers, usually at market value. Many exchanges offer helpful charts with statistics and indicators that are helpful for you to assess each cryptocurrency. Educational material to help you develop your understanding of cryptocurrency and the process and developments in the industry are often provided by these exchanges also. An advantage that exchanges have over the majority of brokers is that many of them have helpful trading tools like APIs, application programming interface, or automated trading tools and bots. These can be used for optimizing trading strategies. Exchanges are useful for long-term trading or hodlers. There are a wide variety of storage options available on these platforms and higher security as a result. These also have an easy sign-up process requiring an email address, photo ID, and the creation of a password. The cons of exchanges. Many exchanges have a withdrawal and deposit limit, which can be troublesome if you require all your cash back in a hurry. Not all of these platforms work in all locations. If they do, they will offer a restricted set of features in different areas. Payouts can be a little bit more complicated and take longer on this platform. In order to use an exchange platform safely and correctly, the user needs to have a strong understanding of cryptocurrencies, secure trading, and the process involved in using it. This may mean that they may be more suited to be a more experienced trader. Examples of exchanges. Coinbase. Features: one of the largest and oldest exchanges. Offers over 50 crypto. Easy to use. Fees and costs: 0.05% to 4.5% depending on the trade. Can include other transaction fees. Pros: has an integrated wallet to send and receive money. Wide range of payout options including bank transfer and PayPal. Low funding amount. Cons: can have high fees. Sometimes glitches when there is a lot of movement on the market. Key: yes, with QR option. Security: crypto is insured against website hacking. Verdict: this is one of the most user-friendly exchanges with an excellent selection, although it has higher fees. Kraken. Features: allows you to trade pairs directly. While the verification process is underway, crypto is stored in cold storage on your behalf. Fees and costs: 0 to 0.26% per trade. 3.75% plus transaction fees for credit cards. Processing fees. Pros: reasonable fees. Lots of pairs available to trade. Good site market information available. Cons: difficult for new users. Slow verification process. Key: yes. Security: high security measures with two-factor verification required. Verdict: although not for beginners, Kraken offers excellent rates and impressive security measures. Bisq. Features: connects peer-to-peer in the true sense of an exchange. For more advanced crypto user, no details stored on the exchange. Fees and costs: low fees that change and are paid in BTC or the site's own crypto BSQ. Pros: one of the very few decentralized exchanges on the market. Good payment options. User does not need a bank account. Cons: difficult for most traders to use. Has to be used on a laptop or computer. Key: yes. Security: decentralized, so very good security. Verdict: while this exchange may be very hard for a new user, it does offer a very solid security system for cryptocurrencies. Chapter 9. How to set up your portfolio. There are plenty of exchanges on the market claiming to be the best at what they do, but how can you tell who to use? Starting out, it can be hard to identify what makes a reliable exchange. This section points the reader to research some of the major factors that they should consider when picking an exchange to use. This chapter addresses several of the key areas that you should consider when choosing an exchange. Some, like security and support, should be non-negotiable. Others, like ease of use and product range, are obviously more subjective. Nevertheless, the more comfortable and secure that you are with your methods of trading, the less likely you are to make mistakes. Factors such as security, support, ease of use, location, and key control will all be addressed and discussed. However, before we address these issues, it is also important to examine a variety of the scam types that involve cryptocurrencies first, so that it is easier for you to identify suspicious activity. Tips on avoiding crypto scams. As with every part of life that is money-related, there are plenty of scams involving cryptocurrencies out there. Some are phishing scams, and others involve money transfer fraud. There are even fake sites and applications that pretend to be legitimate companies to steal from you. It is a good idea to make sure that you are aware of the possible scams before you invest so you can protect your money as much as possible. Fake exchanges. These are sites that are set up specifically to con people out of their money by appearing to be a genuine exchange. They usually offer generous rates and discounts to attract new customers and simply take everything that is invested. It is really important to make sure that an exchange is a real company and to check out its reputation online from multiple sources. Free giveaways. Anything that involves free giveaways is more than likely a scam. These scams often require the user to pay a small fee or deposit before getting their bonus and never pay up. Even worse than that, they can ask for credit cards or bank details and drain your account. Malware. Just like a regular computer virus, these can end up on your computer and copy or steal your information. One type of malware alters the public address that you are sending coins to so that it, unknowingly to the user, is sent to the scammer's account. Be careful and always double and triple check addresses that you send money to. Install decent antivirus software and, if possible, keep your details on an external hard drive. Phishing emails and websites. This is not unique to cryptocurrencies, but can have an impact on them. Never answer or follow instructions on any unsolicited emails requiring you to input your password or details. You can usually tell if these are scams from looking at the sender's address, as mostly they are slightly different to the actual company's correspondence address. Most crypto companies do not contact you unless you have asked for something specific. Forward suspicious emails to the support of the company. Any site that claims to have insider information on crypto. If a company claims to make you a fortune for a tiny deposit over a short period of time, it is not a genuine business. Considering experts are even reluctant to state any absolutes when it comes to cryptocurrencies, it seems highly unlikely that a business that you have probably never even heard of before can. If something sounds too good to be true, it usually is. Fake coins. Do not get involved with companies that are launching a new coin and invite you to a pre-sale event. For starters, the coins may not exist. Even if the coins are actually real, a pre-sale artificially increases the coin's value and then allows the coin creator, who more than likely is a majority stakeholder, to suddenly withdraw from the market with a massive profit. This will leave you with either massive loss, with an investment worth very little, or worst-case scenario, absolutely nothing. Now that we have covered the basics of cryptocurrency scams to avoid, it is important to discuss what you should consider when selecting a legitimate exchange. Security. This factor is the most important for you to consider. Although this has been mentioned continuously throughout this book, hacking has the potential to completely drain your hard-earned investment, and this is why it is of paramount importance. Check the reputation of the exchanges beforehand that you plan to use, as many decentralized options and brokers can be more susceptible to attack. As we have seen, some platforms are regulated, others have insurance, while others have high security in place. The more of these that a platform has, the safer for your crypto investments. The more wallet options that you have, the better. Some exchanges may not let you store money elsewhere and only allow it on their integrated site. Brokers usually do this as well, which means that you do not have full control over your own security. Reputation. To find an exchange that best suits your needs, consider using a few different online crypto exchange comparison sites, as these constantly update and give the pros and cons of each of the products. To be on the safe side, use a few to get a better picture with less of a chance of product placement or bias. Scour online forums and see how the response has been to exchanges and see what most people recommend. If there have been any serious issues with the platform, you can bet your bottom dollar that you will find out about it online, particularly in the crypto community. Popularity. It is one thing to have a good reputation, but if no one is using the site, there must be some reasons. Check to see how many people use it. There is a reason that many people use the same product and why others choose to use a different one. Perhaps one is more user-friendly than the other, and you're not the most tech-savvy person. Look at the reason why people are choosing to use one site over another and cross-reference these with your specific needs. Product range. Oftentimes, the bigger the product range, the more organized an exchange is. Also, the more choices that you have, the more confident that you can be that there are options to move your currencies around into. The larger exchanges usually have the best offerings in terms of product range. Couple this with their membership, reputation, and good technical support, you can be relatively confident in your choice. Support. Technical support can be vitally important when trading on an exchange. Glitches in trading or mistakes, although mostly irreversible, can be helped or prevented by having good support on your exchange. Educational material about the ever-changing world of crypto is also provided by many of these companies, and encouraging and educating people most certainly makes a platform seem to be more trustworthy. Key control. Do you control the key? Attacks on your crypto are easier if you don't. Most exchanges do have insurance, but if you lose your crypto through any fault of your own, you are not covered. Should the app crash, does this mean your crypto is lost forever, or does it mean that the broker or exchange get to decide when you cash out? Can you set keys and passwords on your wallet? The more control a platform gives you, the more reliable they are. It also means the easier it will be for you to secure your own crypto yourself. Controlling your own wallet is better for you in the long run, but it does mean that you have to be extra careful with your investments and store them in an exceptionally safe place. Chapter 10. Viewpoints on exchanges. Honestly, exchanges seem to be the best way to go with your cryptocurrency investments. Brokers, while they might be good for someone who trades in regular stocks and shares, or someone with little to no trading experience, are more expensive, give you lower rates, and leave you with less control over your storage. Recently, Robinhood restricted customers' ability to buy and sell GameStop shares as a result of the huge sudden price increase, leaving people locked out of their accounts. There was obviously an uproar about this situation, as people were not allowed to do with their own money, and the legality of what Robinhood did was brought into question. Having control over your own investments, no matter how daunting that initially may be, is the best way to be able to make your own decisions confidently and become a competent trader. Your best chance of this is with an exchange. This chapter discusses some of the considerations to keep in mind with exchanges. Like the previous chapter, it mentions some of the secondary considerations that you will need to factor in to use the exchanges. Here, ideas on ease of use, tools and charts liquidity, location, and wallet range will be expanded on as well, giving you a better picture of what you are looking for to meet your specific needs. Exchanges may be a bit daunting, as a pure exchange or a decentralized exchange can be difficult to use if you are unfamiliar with how cryptocurrencies work. There are, however, plenty of resources available online to walk you through the individual processes on each of these exchanges. You will be more anonymous and as a result more secure, but you will have to take your time and be careful with every step of each of the transactions that you conduct. However, the most fitting option for many is using a centralized exchange, which often features an easy-to-use interface and many of the time-saving traits of a brokerage account. The integrated wallet that is a part of most of these companies can be quite helpful in the early stages of your trading, but it is important to make sure that you can move your funds to a secure external place. The downside to the centralized exchange is that it is less secure and anonymous than a decentralized exchange, as you will most likely have set up your account with verified details and identification, meaning that you are not fully anonymous. Ease of use. The easier an interface is to use, the less chance you have of making mistakes and costing yourself time and money. Sometimes a platform can have all the best features in the world, but it does not feel right for you. An easy-to-use platform, even with pared-down extras, can sometimes be the best way for you to navigate investing in cryptocurrencies. Ask yourself whether the platform is easy to navigate and how easy it would be to make a mistake on it. For example, instead of selling, how easy would it be to buy by accident instead? Does it glitch often if you are using it on a phone or laptop? Are the instructions intuitive enough, or will you have to read up a bit on it? Is it simple enough to make payments and cash out? Tools and charts. You may be interested in the tools and charts that are incorporated into a platform, and this may be something you feel would be helpful for your investing. While charts can be found easily enough online, it can be helpful to have instant access to them when trying to make a purchase. The next chapter explains some of the key terms used in trading charts, many of which are included on exchanges such as Coinbase. Some platforms also even contain links to mentions of relevant information about cryptocurrencies in the news, which can also be helpful. Whatever your decision, charts on a platform can be a helpful bonus when making time-dependent decisions and are useful when you are casually researching on your phone. APIs, or Application Programming Interfaces, are a set of functions that allow applications to access data and interact with external software component systems, or microservices. In other words, these are functions that you can set up on some platform that perform automated services on your behalf. Not all platforms offer these, but they are a good option to avoid losses as cryptocurrencies trade 24 hours a day and markets can change dramatically overnight. For example, you can set up a reoccurring purchase that will be actioned when the currency of your choice hits your desired entry point. You can also opt to have your investments cashed out in a similar fashion. In technical and more traditional trading terms, this is referred to as a stop point. This protects you from losses in what can be, at times, a very volatile market, and you can wake up in the morning seeing that business has been conducted on your behalf. The only downside to putting a stop-loss order in place is that even if your investment only hits your desired price for a very short period of time, the sale or purchase will be actioned. So it could be the case that the price that continues after the order corrects itself. Still, all in all, given the extreme fluctuations of cryptocurrency, it is better to err on the side of caution. Liquidity. Being able to cash out easily and efficiently is also an important factor to consider. As well as bank account payouts or allowing your money to sit in your wallet, Coinbase, for example, gives you the option to cash out into your PayPal account, which is convenient and straightforward. Most exchanges allow their customers to simply deposit in their accounts, which, depending on the type of payment, may take up to a few days. Other exchanges put your currencies into cold storage while they wait for them to be validated. Again, make sure that you can cash your investments out easily and can access them at any point. When opting for a payout, make sure that you have a good internet connection. Also bear in mind, in times of high movement on a platform, it may be slow or crash. This is not ideal at the point of a payout, particularly when even a difference of seconds can make a massive difference to your returns. Location. Some exchanges are not available in certain locations, so before setting up your account, make sure it is in operation where you live. Also, some brokers and exchanges will allow you to use their services, but may not have the features to allow you to withdraw. In this case, you would have to send your currency again elsewhere and incur extra fees, so it is very important to do some thorough research into the exchanges that you are planning to use, despite what they promise to be able to do. Fees. There are many ways that you can eat into your return on cryptocurrencies without even realizing it, and fees are one of them. Not only may your bank charge you for your initial transaction, but every exchange collects different transaction fees based on payment method and fees based on purchases and cashing out. These may appear small and are usually less than 3%, but these can eat away at your investment before you have even started. These fees are always subject to change and vary according to the coin that you are purchasing. This money pays the platforms and the miners who validate the transactions, which is fair payment, but you will need to shop around to find the best prices for an exchange if this is a mitigating factor for you. In fairness, brokers charge substantially more than the exchanges generally do. The lowest fees with the exchanges come mostly from decentralized ones, although they are more difficult to use, and centralized exchanges are easier to use and for the most part have slightly higher fees. It really is a trade-up between usability and fees in a lot of cases, so that decisions should be based on how comfortable you feel with either. Chapter 11. Chart Indicators. This chapter is a glossary of terms that apply to the principles of trading generally, but can be applied to the crypto market too. By learning how to identify patterns in the life cycle of a coin and judge how it performs, it is possible to gauge public sentiment around it and understand whether it has the potential to earn money for you. Depending on how you wish to invest, short term, less than 3 months, medium term, a few weeks to a year or so, or long term, several months to years, the information needed from these statistics can be adapted to meet your needs. Each of these terms may have different variables to consider, such as market corrections and market conditions, and many younger cryptos may not necessarily have the history to make an accurate assessment. This is why the terms below should serve as accompanying tools for your primary research as mentioned in Chapter 7, keeping your goals in mind at all times. We have already briefly looked at bullish and bearish markets, which will be explained again here in greater detail. Market capitalization, circulation, and time in the market, and when looking at which digital currencies to add to your portfolio, but this section deals with some slightly more technical terminology that you may hear from time to time. With many exchange interfaces, as well as online crypto pages, you will be able to collect all this information in real time, making it easier and more efficient for you to decide when to buy in. The more informed your decisions are, the calmer and confident you will be that you have minimized the risk of investing as best that you can. You can limit your exposure to risk in a few ways by considering trading initially on younger cryptocurrencies, leaving your currencies in for long periods of time like the loyal hodlers do, only investing small amounts, researching the market, considering investing in sustainable cryptocurrencies, and avoiding panic buying and selling. Obviously, all trading comes with its own risks. However, it has been said many times that the greater the risk, the greater the reward. This is what is known as the risk-reward ratio and should be considered when you are choosing how much to invest and where. That's not to say that you should roll the dice on your life savings, but make sure that what you choose to invest in a volatile market is something that you would be comfortable with losing. However, the rewards if you do succeed with crypto, particularly a young and inexpensive coin, could potentially be life-changing. Glossary of terms. Bullish. A bullish trend refers to a market moving aggressively towards growth. This means that people are willing to invest and that market behavior indicates that there is a positive attitude in the market. Prices will increase during these times, and it can cause emotional traders to get caught up in buying as prices increase. Bearish. Bearish indicates an apprehensive approach to the market. There may be very limited growth, none at all, or a slight decline. When this happens, it means that people are selling the investments or holding them, but there is limited buying. Prices may lower or stay roughly the same. This cautious attitude can be the result of fear that prices may drop further in the immediate short term. Buying during this period can be a good option depending on how the price is faring. Support. When a price drops suddenly but stalls around a given figure, this is said to be its support. This is the lowest price that a stock, asset, or currency is expected to waver around. This is the baseline price level for a currency that is expected during a cycle. This is based on looking at a chart's history over a certain given period of time and cross-referenced with other variables. Sometimes a price will struggle to beat a certain resistance level, explained below, but stay close to it. When this happens several times, this is considered a safe range. For example, at time of writing, Bitcoin is resisting 42,000, which means that it is finding it difficult to pass this price. Its support is within a $5,000 range of that. By looking at support and resistance levels, it is possible to tell whether a coin will increase or decrease. The more of these points that it hits on the up or on the way down, the more momentum it builds one way or another. Moving averages. This term is often used in technical analysis of charts and keeps track, or a running total of, the average price of an asset. From this, a trader can work out the average cost of stock in a certain time, whether there have been extreme increases or decreases. This allows for a more accurate picture of the market, including sudden price changes. You can calculate the moving averages, or MA, over any period of time over 15 days, so it can be adapted to short, long, or medium-term investment strategies with ease. This helps you identify whether the current pricing is below average, and if it is, decide whether you should purchase on that basis. However, the longer the time period the average is calculated on, the better the picture of the market will be. This gives more of a baseline of what the less extreme the costing is, as it gives the market more time to correct itself, whereas these corrections may not be as present within a shorter time frame. Say a coin's average over the last 60 days is $1, but it is currently trading at 50 cents. It may be a good opportunity to consider buying it. Calculating this average gives you a good idea of what the chances of an increase or decrease are and maximizes your chance of profit. Volume. This term is used to refer to the cost of all sales and purchases on a certain day. This all depends on the movement on day and is usually updated hourly. The more movement of a currency or asset that there is, the more favorable the attitude towards the currency is said to be. If there is a consistent increase or decrease on a day-to-day basis, this is indicative of the market sentiment surrounding a coin and also a key variable to consider for buying and selling your investments. Resistance. Like the support level listed above, resistance is also indicative of a stall in pricing. While the support level, however, refers to the lower end of the scale, the resistance shows stalling near a level for increase. If it eventually results in an increase, another higher resistance level is set. There are many ways to calculate this, including analyzing previous highs and lows throughout its history, and using strategies such as Fibonacci retracements, Bollinger Bands, and trend lines. Breakout. A breakout is as exciting as it sounds. This refers to a strong, sudden move that sometimes defies predictions and can accelerate quite quickly. It can also mean that a price that has been uncharted for the asset has been reached. Remember when we discussed Bitcoin's halving roughly every 4 years? Each time this happens, Bitcoin's price soared dramatically, the very definition of a breakout. Consolidation. Consolidation is your investments taking a rest and having a stable price. This can happen after a high momentum period, either on the rise or decline, as it looks like the asset is trying to find its feet. The longer a price remains stable, the more likely a dramatic move is in the future. These can be identified on charts with pennants, wedges, and rectangles. Cycles. These are the visible patterns in a chart over a certain period of time. The average length of a cycle can be calculated by measuring the time periods between the lowest points across the waves. This can give you a good idea of when another cycle is starting and an idea of whether some movement in either direction is to be expected. It also gives traders an idea of when highs and lows will end and paints an accurate picture of pricing when history repeats itself. Relative Strength Index, RSI. This tool helps a trader analyze when there are uncharacteristic highs on a chart and estimate what the real value of the asset is. They also can help gauge trends regarding drops, allowing traders to pick adequate entry points. These can be extremely useful for short-term investments and help calculate the probability of the trend reaching a certain value. The higher the RSI reading, the more bullish the trend. Swing. A swing sounds exactly like what it is: a smooth, uninterrupted movement in an upward or downward motion, and it can be either bullish or bearish. A bullish swing is considered one that, for the most part, consistently rises, while a bearish one lowers. The market's strength, trends, and potential price differences over a period of time can be identified from this. Trend and trend line. A trend is a set of higher highs and lows, which signal a bullish market. A bearish market trend has lower swinging highs and lows. Moving averages help a trader to decipher the direction and strength of a trend of an asset by assessing whether it is decreasing or increasing over a certain period of time. Using the Average Directional Index, ADX, and Directional Movement Index, DMI, together also results in the ability to identify trends. Trend lines, on the other hand, are a test of the support and resistance of a market. This gives an accurate picture of when a good entry point to the market is. It is calculated by looking at the relationship between at least two of the most significant swings on a chart and using that information to predict future prices. The more times that these calculations and figures are proven to be correct, the stronger the support and resistance levels are considered to be. Stop loss. This can be an actual tool or a physical instruction that cashes out your investment if they decline or increase once your funds reach a predetermined threshold. This is to limit losses or to avoid losing money suddenly after its predicted peak. They can also be known as market orders. Many exchanges and brokers have this offering in their arsenal to help crypto traders, as the crypto market is 24 hours a day and it is impossible to always remain vigilant. For example, say your coin is currently trading at $2. According to your research, history shows that if it reaches $3.50, it is likely to almost immediately plummet to $1. If you set it up so that once it reaches your target price of $3.50, or even $3.40 to be on the safe side, you can be assured that nothing extreme will happen to your funds while you sleep. APIs. This stands for Application Programming Interface and is software that allows two other applications to communicate directly with each other. For trading, this would include market orders to buy or sell that can be automatically applied to your account should a certain price be reached. These are considered very important in trading and are based on a series of algorithms that perform a variety of automated tasks. Chapter 12. Key Takeaways. Well done on making it this far. That was a lot of information to take in, so for your convenience, here is a breakdown of the main points of each of the previous chapters. Chapter 1. What is cryptocurrency? Cryptocurrency is a digital currency that differs from physical fiat currency and has become a source of excitement and investment in recent years as interest has grown. It has grown so much that there are over 10,000 cryptocurrencies currently on the market. Its value is derived from how popular it is as a store of value. There are several different kinds of crypto, ranging such as coins, tokens, and stablecoins. Chapter 2. What is blockchain? These currencies use an organizational system called blockchain. Data is assigned to transactions in a block and is linked sequentially together through code. This large shared network, which is decentralized, makes the process more transparent and trustworthy. Chapter 3. What is cryptography? Blockchain transactions are encoded to give privacy to its users by a method called cryptography. Cryptography is centered around creating security in communications where only sender and receiver can view the encrypted information. Each crypto wallet user will need both a public and private key to send and receive money. Keeping a private key hidden is of the utmost importance to protect your crypto. Chapter 4. What is cryptocurrency mining? Coins are created by miners who work to solve problems on the blockchain and assign them data before being rewarded in crypto. Miners use a system called proof of work to claim their rewards. Mining is very competitive as rewards lower every few years. Miners have begun to pool their interests and buy more powerful, expensive equipment to process the solution through a system called proof of work. This has had a serious impact on energy consumption and emissions. Chapter 5. Entering the crypto market. Define your goals clearly before beginning your portfolio. Decide how much and how often you can afford to invest in cryptocurrencies. Learn to not trade emotionally. Research the market. Chapter 6. How to buy cryptocurrencies. In order to buy cryptocurrencies, you will need to set up an account on an exchange. Many exchanges have integrated wallets, but it is highly recommended that you set up your own separate, more secure wallet elsewhere. Some of these are cold wallets, which are extremely secure, and hot wallets are online and less secure, but easier to access. Setting up an exchange is usually very straightforward, but check fees with your bank and your exchange and keep notes for tax. Make sure your bank will let you deposit crypto into your account also to prevent your money being frozen and mistaken as fraudulent activity. Chapter 7. How to set up your portfolio. Picking which crypto to include will involve some research on your part. Look at who the investors are and their engagement in the community. Assess how realistic their plans are and whether there is a market for their coin or token. What is the media saying about them? Learn some of the key terminologies of market capitalization, circulation, and time in the market to also gauge whether a cryptocurrency is worth investing in. Chapter 8. The difference between brokers and exchanges. Choosing whether to use a broker or an exchange is also an important decision. A broker such as Robinhood, eToro, or Bitpanda provides currencies at a rate set by the company, but it is easier for investors to use. An exchange such as Coinbase, Kraken, and Bisq allow investors to trade directly with each other for a fee. These are sold at market value but require a good understanding of cryptocurrency for the system to work well for you. Chapter 9. How to find a reliable exchange. There are two types of exchanges, decentralized and centralized, which offer different ways to exchange. There are many factors involved in choosing an exchange that is suitable for your needs, but again, your primary concern should be security. Other variables such as support, reputation, product range, and control of keys should also be taken into account. Chapter 10. Viewpoints on Exchanges. Ease of use is important when selecting a cryptocurrency exchange, and the decentralized ones are much easier to use. The liquidity of your investments is important to remember should you need your money in a hurry, and popular sites are usually good for this. You need as much control over your investments as well as good access. Be aware of the possibility of glitching on interfaces that may cause mistakes to happen. Not all exchanges work in all areas or may have limited functionality depending on where you live, so carefully research them beforehand. Many exchanges have helpful tools and charts that can be used to help you strategize more effectively. Chapter 11. Chart Indicators. Watching the market will help you pick decent entry and exit points. There are several ways you can look at a chart to attempt to identify the strength and patterns of a cryptocurrency. Using terms like moving averages, support, volume, resistance, cycles, swing, and relative strength index will help you make the most of your money.